Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
U.S. Secretary of State Antony Blinken arrives in Turkey as part of his latest regional tour to try and prevent a spread of the Israel-Hamas war. Berkshire Hathaway is sitting on a record cash pile boosted by higher interest rates and a lack of takeover candidates enticing enough for Warren Buffett. Investors ramp up the bets on interest rate cuts in the US and Europe. We hear from Jerome Powell, Christine Lagarde and Andrew Bailey pushing back against the narrative. Very good morning to you. One thing is for sure, the equity markets are not paying major attention to the data, the services data, the softest in 5 months, the jobs report weaker than expected, the unemployment rate rising. That is all a momentum that the equity market does not want to listen to. S&P 500 up nearly 6% last week, building on that. The Nasdaq was up 6.5% last week. You're looking at the best runs in these markets since June. It is about the yield collapse, down 40 basis points since Tuesday. So that narrative bolstered this sense of euphoria in stocks. The yield slide also took the VIX down, the biggest plunge, the biggest weekly plunge in 21 months. So that repressed volatility, is that something you buy at that level? Do these stock markets need to start listening to the knocks on the door from the data? By the way, it could be that fear is just as costly as greed. That's according to Bank of America. And Mike Wilson, however, he warns that these gains that you've seen in these markets are nothing more than a bear market rally. Let's hope not. I'm starting a 401k. A whole new world for me in America. Now, when it comes to stocks in Europe, it's the Stoxx 600, dips ever so slightly. Let's see what Lagarde fights back this week, Danny, in terms of rate cuts narrative. But Ryanair takes the crown. The first ever regular dividend from Ryanair. They're cautious on deliveries, but 400 million euros, that's a payout to the shareholders in Ryanair. Danny, good morning.
Good morning, Manus. This is so exciting. We can compare 401ks. What a fun activity for you and I to do. All right, you mentioned the drop in 10-year yields. We are giving some of it back today. There is some selling in the Asia session into the European session, higher by about 1.5 basis points. But still, the message in bonds stands clear. We moved from 5.5% to 4.5% in less than 2 weeks. Again, it is that movement after some of the data we had and maybe a more dovish Powell than expected. Bloomberg dollar spot, that continues to weaken. It dropped on Friday, its biggest amount since July, so that also matched what we saw in yields more or less. Crude, that's up nearly 2%. We did have some of the war risk premium get priced out, though gains are being priced back in after Saudi and Russia over the weekend reaffirmed their desire for supply cuts. So, Manus, we have a maybe kind of sanguine market, maybe following on from the trends of last week, but can that stick? Our producer made this great and perhaps terrifying calendar for what's ahead for the week. We have central bank speak from Bailey, from Powell, and Christine Lagarde. Powell and Christine Lagarde are going to be speaking 2 times next week, Manus. Are they going to try to bat down the narrative that the market's currently carrying that we're going to get 100 basis points of cuts in 2024?
Well, of course, the issue is the dirty work done by the bond market, as you say, Danny, has been done. I would put it to you, and we looked at it a few times last week, we've got not just easy FCOM, but the risk is that financial conditions become a little bit light. And that is exactly what all of them do not want. They need to grasp that nettle and push back against the rate cut narrative. Some breaking news, Danny. I think you've got it on Yellen.
Yeah, we'll take those lines to Kokou in a moment. But first, yes, some lines on Yellen. U.S. Treasury Secretary Janet Yellen and her Chinese counterpart, Manus, are going to be holding 2 days of talks in San Francisco this week. That'll be from November 9th to 10th. Is a step towards more normalized ties. And, Manus, a long-awaited meeting between the leaders of the world's 2 largest economies. Yep,
of course, that quiet geopolitical, I suppose, building while you have the war between Israel and Hamas, you have the Ukraine funding, a whole host of other issues to deal with. Let's reset to the markets. Kokou Agbo-Bloua is global head of economics over at SocGen. Kokou, always great to get you with us. We started the show talking about this, I suppose, demonstrable drop in yields last week. The bond market has pretty much undone some of the dirty work that the central bankers were banking on. Do you trust a drop of 40 basis points in the 10-year government bond yield in the United States, that virulent repricing that happened last week from 5% a couple of weeks ago to 4.5%? Are we done with the test of 5%? Good morning.
Good morning to you, Manus. I think it's quite interesting because the rhetoric of a lot of investors and economists and strategists has been that we are due for a recession because we have raised interest rates, central bank have raised interest rates quite significantly, and this ultimately needs to slow down the economy. And our house view is for a recession to occur in the second half of next year. Bearing in mind that the market was hoping for, expecting a recession end of this year, then it was Q1 next year, etc. Then we had a series of very strong data, and that triggered, in addition to a lot of supply-demand dynamics, bond yield, breaking the 5% level. And then the conversation was how high can bond yield go because the economy is so strong. And the strength of the economy is essentially driven by companies having developed a natural immunity against interest rates. They essentially have locked in long-term, long duration or long maturity in terms of financing. But now we're starting to see weakness in the data, and this is essentially behind the collapse in bond yield. So I think that we are going through a process of readjustment towards a no landing scenario, from a no landing scenario to a soft landing scenario.
Okay, so more needs to be priced in, but if what's happening there is this realization that perhaps there will be some sort of landing and the economy is not as strong, it gets back to what Manus started the show with. What in the world is happening with equities? Jean Boivin over at BlackRock addresses this too. He writes, Kokou, that the question we ask is if the surge in rates has fed through to equities, and our answer is not yet. We think there's more downward adjustment to come, but we see a better environment in 2024 once the adjustment is complete. Kokou, do you agree with that? Is there a downward adjustment that needs to also happen in equities?
Yeah, I mean, this is a brilliant point. I think people tend to forget that equities are driven by two factors: the discount rate, which the central bank can essentially drive and control, but also growth of earnings. And the reason why bond yields have gone up so much, it's not only because of higher interest rate, but it is precisely because the economy is also growing. So if we have an environment of strong growth, you'll see equity go up and bond yield go up at the same time. The question is whether rates will stay higher longer than the strength of the economy. And one of the things with equities is that they are immune to interest rates, at least transitory, simply because they have they have done a process of balance sheet repair by locking in long-term interest rates at roughly 3% for IG. This is 5 to 7 years maturity. High yield is shorter, 3 to 5 year on average. So they're not sensitive to the higher interest rate. And the second key point is that they benefited from greedflation, i.e. they've raised their prices by more than was warranted and managed to got away with it because of excess savings. So equities are essentially resilient because underlying strength and profit margins are high, but you need to wait for the next refinancing wall, which is likely to be in 2025, and a slowdown in the economy before the market takes a hit.
Well, I just bought a coffee over the weekend, so I can absolutely assure you, I won't tell you which brand, but it was rampant greedflation. You can all IB me, and I can tell you which one it is. On that note, the risk is this. FCON, if you look at FCON, this is what Lagarde, Bailey and Powell perhaps need to push back against, Kokou, because the market now thinks 100 basis points of cuts by December of next year. Here is FCON. It's turning easy, but what is the risk? And I don't think it will, but I'm curious to see what you say. I don't think it'll become lush. I just wonder, does this FCON, I suppose, easiness run out of puff?
Yeah, I think if you look at real interest rates, so financial conditions are clearly not as tight as they ought to be or could be. And this is, again, a question with regard to the consumer. Because they've essentially had, excess savings to the tune of $2.5 trillion in the U.S. at the peak, so 10% of GDP. So today it's probably down by roughly 60–70%, depending on the assessment. But this have acted as a buffer. The last but also very important point is fiscal spending and the U.S. election next year. So one of the driver of the resilience is not just because it is not just about quantitative tightening and higher interest rates. Is we did not have a fiscal tightening, because you have to remember the original sin, so to speak, or the reason why we are in this high inflation environment is because of a fiscal whatever it takes response to COVID to save human lives. And this kinetic energy that was injected in the economy is still driving growth, and fiscal stimulus and the budget deficit is still a key driver.
Okay, Kokou, stick around with us. We have much more to discuss. Kokou Agbo-Bloua from SocGen. First, Manus, let's get to some of the other top stories that are trending on the terminal this morning. Telecom Italia has approved the sale of its domestic landline network to KKR. That'll be a deal for $23.6 billion. The company made the deal without making it conditional on a vote by shareholders, with the sale expected to close by next summer. Telecom Italia's biggest shareholder, Vivendi, opposed the agreement and said it would use any legal means to challenge it.
About 300 Wall Street executives are expected to attend a global finance summit in Hong Kong this week. Citadel's Ken Griffin, Goldman Sachs' David Solomon, and Morgan Stanley's James Gorman are descending on the city where finance firms have slashed hundreds of top jobs. But Hong Kong has still one key feature that ensures firms keep a foothold. It's the economic and financial links to the Chinese mainland.
Well, Manus, Elon Musk has revealed his own artificial intelligence bot to challenge ChatGPT. The billionaire says the Grok platform will pull real-time information from messages posted to X and has a, quote, rebellious streak and, quote, loves sarcasm. A limited group of U.S. users are testing the prototype, which has been in development for 2 months. Loves a bit of sarcasm, rebellious. Sounds like Bloomberg Brief to me, Manus.
I don't think it'll troll my Twitter. I don't think there's anything. It's just factual, unemotive, on like my Instagram. A little bit more me. Coming up in the show, it's Monday morning. What better way to kick it off for you than to understand what Warren Buffett's actually doing? Berkshire Hathaway. We discuss what the billionaire and where he's piling his cash on the curve. That's next, Danny.
And Secretary of State Antony Blinken visits Turkey to stop the spread of war as Israeli troops encircle Gaza City. We're going to discuss that next on Bloomberg. This is Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. Manus, let's talk Berkshire Hathaway earnings. Over the weekend, their cash pile had a fresh record, $157.2 billion. It had both rising interest rates and a lack of deals on its side. Joining us now is Bloomberg's Charlie Wells. Charlie, how did they pull off the beat in operating profit?
Yeah, Danny, so it's all about insurance here. So, Berkshire Hathaway is such a bellwether for the American economy. They are so diversified. Insurance, it's rail, it's Dairy Queen, it's Nebraska Furniture Mart, so many different businesses. And last year was a really tough year for insurance, which Berkshire Hathaway is so invested in. They've got Geico and a number of others. But actually in the third quarter, profits from insurance actually brought in $2.42 billion, which helped offset some of the weakness. Now, Berkshire saw some weakness in the likes of railways. They saw some weakness in the likes of home builders. But it was that insurance boost that really helped them in the third quarter.
Manus, have you ever eaten at a Dairy Queen? You're in America now.
Do you know what? I was just going to say
it,
Charlie. I have no idea what Dairy Queen is. No, I'm just getting sort of a reality check on food options in the U.S. What is Dairy Queen? Before we move on to $157 billion, what can I get at Dairy Queen? Anything healthy? Doesn't sound like
you could get, I think, a Frosty. They have some really good ice cream. Yeah, nothing healthy. Sorry, Manus.
Okay, Irish man abroad in New York. Send in your IBs on what I can get to eat at Dairy Queen. She's bad, isn't she? $157 billion. So even I'm opening a cash account. So you've got to say to yourself, okay, it's still rich pickings at 5.5%. Is it rich enough for Warren?
That's a great question. And I mean, this feels almost like the most frustrating shopping trip that you've ever been on, where you've got the cash, you're looking around, and you just don't see anything to buy. And that's a really big issue because Warren Buffett is the world's biggest value investor. He finds great value, and in this environment just doesn't seem to be seeing that and is holding on to this cash pile. But we also know that a lot of this money is parked in short-term treasuries, and what has been happening with treasuries recently, their yields have been elevated. So that partially explains this huge cash pile. But it also is this fact that, at least for Berkshire Hathaway, it doesn't seem like there's a lot of good stuff to buy out there right now.
And Charlie, you kind of mentioned this, but I want to get more into it. Besides showing the world Manus's taste for fast food, they own everything, right? From, as we said, Dairy Queen, insurance business, rail. What did it show us about the American economy?
Yeah, I mean, Berkshire Hathaway, headquarters in Omaha, middle of America. This is a company that really is in the middle of the American economy. And it's interesting. I mean, we've seen with the American economy, higher interest rates, posing some problems for the economy, but still, chugging along. When you look at Berkshire Hathaway as well, you see under the hood some stress for these higher interest rates, on those home builders, on certain segments. But at least when you look at some of the retail businesses within this huge umbrella of Berkshire Hathaway, when you look at some of the manufacturing, they actually had some growth in the third quarter. So, not as dark of a picture as one might think. And actually, Buffett earlier this year at that AGM, his very famous meeting in May, kind of warned that there could be some potential downsides coming forward for earnings. But the worst case scenario doesn't seem like it's spelled out.
Yeah. All right, Charlie, thank you very much for joining us. That is Bloomberg's Charlie Wells. And SocGen's Kokou Agbo-Bloua is still with Manis and me this morning. Kokou, look, we have this cash pile from Warren Buffett. If you look at just the broader market, Bank of America had this research out last week saying that cash inflows are annualizing $1.3 trillion. If I can go to the very, very front end, if I can go to cash-like instruments and get 5%, why go anywhere else right now?
Yeah, I mean, cash is definitely king, and the king is back. So, I mean, Warren Buffett with $157 billion is essentially, if he were to put all of that in money market funds, he would be essentially annualizing $8 billion in excess in interest income. And this is pretty spectacular. So from an asset allocation perspective, I mean, cash used to have negative interest rates and was a drag in performance. And today, it is clearly a major diversifier, particularly in an environment where equity and bonds are essentially moving in the same direction and not providing the same diversification with huge duration risk. So yeah, and this is one of the reasons we see so much volatility in the long-end bond market, because there is an alternative today, and that's cash, and it's yielding a pretty attractive carry.
Kokou, let's just extend on that, because one of the great debates is when is there enough term premium in the longer end of the curve to tempt investors in? What is the clearing price for bonds? What's the clearing price for the auctions? We'll see a little bit this week. You, before the hurly-burly of last week, were suggesting that term premium in the US and in Europe could extend a little bit more. And I just want to get a sense, do you still believe that? Do you think that term premium will rise by another 30 to 70 basis points in the United States of America? And is that what it's going to take before you see significant buying? Or do you think we've already seen the beginnings of that, and maybe term premium does not need to rise as aggressively as perhaps you once thought?
Well, I think term premium will have to rise as we get closer to the end of the business cycle. Typically, historically, we tend to see a more of a bull steepening with a 2-year essentially pricing more of a recession and cuts, and the long end starting to price the normalization of the cycle. What was pretty unusual this time around was a bear steepening with the long end selling off, even though we are supposed to head to a recession. And I think that volatility was driven by technicals, the excess supply of Treasury by the U.S. Treasuries, and then the dynamic of lack of carry. But I think now the next step would be to see more of a bull steepening as these rate cuts essentially gets priced in and the economy slows down into the second half of next year, which is our core view at this stage.
Okay, all eyes down for the second half of next year. We can all breathe a little bit of a sigh of relief between now and then, and I can go and investigate what I can buy at Dairy Queen. Kokou, always great to get you with us. Kokou Agbo-Bloua there on the markets with Danny and myself. Quick snapshot of the bond markets. You just heard it from Kokou Agbo-Bloua himself saying SocGen calling recession in the second half of next year. 100 basis points of cuts are priced in. Yields rising ever so slightly this morning, 2.7 on the 10-year government bund in Germany. Good morning from New York and London.
This is Bloomberg Brief. I'm Danny Berger in London. Manis Cranny is in New York. Manis, a story from the FT that caught both your and my eyes, talking about BCG, McKinsey, the big consultancies of the world. Last year, there was this immense talent war. They raised starting salaries by the most in 2 decades. bad news for those who are starting out and going to be hired by them this year. For those being hired in 2024, you will get the same salary as the class before you. That's right. They have frozen the starting salaries, Manus.
There's a lovely line in this story, isn't it? You know, it's the hangover party. But we should just say that at McKinsey, if you've gone and you've done your higher MBA, you get $192,000. And how much does it cost to go to Harvard for 3 years? I haven't met many people from Harvard or Yale yet on this trip.
I do think it's 2 years for a business school. I could be wrong there, but $75,000 is how much that'll set you back. So, you know, you'd hope you'd get a pretty solid starting salary if you're going to spend that much to go to business school.
That's still a positive return. I still go back to, I mean, you know, I wanted to come back as a young junior investment banker. Truly what I want to come back as the class of 2023 that did their internship at Citadel. Their interns, Citadel Securities, paid up $120 an hour for the young ladies and gentlemen and kids to come in. So you know what? There's still money in finance.
There's still money there. It might be frozen from last year, but it's still there. All right, Manus, a quick look at these markets as we take you to the break. S&P 500 futures, after the best week of the year, are up 0.2%. Brent crude up nearly 2%.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. U.S. Secretary of State Antony Blinken arrives in Turkey as part of his latest regional tour to try to prevent a spread of the Israel-Hamas war. Berkshire Hathaway, it's sitting on a record cash pile boosted by higher interest rates and a lack of takeover candidates enticing enough for Warren Buffett. And investors ramp up bets on interest rate cuts in the U.S. and Europe. We're going to hear from Jerome Powell, Christine Lagarde, and Andrew Bailey this week. Now, ahead of all that central bank talk, we are seeing some selling in the 10-year. Yields are higher by about 2 basis points, but that doesn't do anything nearly to undo what we've seen over the past week. We went from 5% rates to 4.5% rates. We saw the biggest drop, the fourth biggest drop since the great financial crisis. Likewise, we also saw a weakening of the Bloomberg dollar index. That saw its worst day since July on Friday. So that trend continues. Again, as this market starts to price in sooner rate cuts, we're now betting on June is when the rate cuts start. Previously, before last week, it was July. Meanwhile, NYMEX crude, New York crude is up nearly 2%. This follows over the weekend. We heard from the Saudis and from the Russians, Manus, affirming that they would indeed hold on to those supply cuts.
Well, Danny, that fourth biggest drop in yields gave an irreverence really to risk, didn't it? It let the equity market go on a tear. You're looking at the S&P 500 was up 6% last week. It builds on that narrative. The Nasdaq was up 6.5%. The market, the equity market, is paying no attention to services at the slowest in 5 months, paying zero attention to the jobs report, apart from the fact that they can now price in. They're unbridled in their pricing in of 100 basis point cut by the end of next year. And it is that pricing of rate cuts that gives these equity markets a new infusion. Add on to that, you have the second biggest issue, which is, of course, from Kokou Agbo-Bloua over at SocGen, which is there's a kinetic energy to these equity markets because they are refinanced. Investment grade has refinanced themselves probably for the next 3 years. So these equity markets, VIX is dropping, the biggest 5-day drop in 21 months on the VIX. By the way, fear can be just as costly as greed, according to Subramaniam over at Bank of America. The reason why we've got the Stock 600 up here for you, it dips ever so slightly, is because we've got Ryanair, the first ever regular, normal, run-of-the-mill, oven-cooked dividend, 400 million euros. They're cautious on deliveries, and they have very limited visibility. So maybe that full revenge tourism dissipates for the winter season. We'll hear more from Michael O'Leary later in the day. We've got the CFO sound coming up. Danny.
I still think that was so interesting from Kokou, because we talk all the time about why aren't stocks reacting more to bonds? If the economy is getting worse, why are stocks still rallying? He talked about the resiliency in stocks. And again, I find this very fascinating, that stocks will be resilient until the next refinancing wall. And Manus, according to Kokou, that's not going to be until 2025. If rates aren't going anywhere, or if they're coming down by 100 basis points and more, I mean, stocks can probably hold up then.
Well, that then bolsters the idea of no landing to maybe, if you do pay any attention to the data that you had on Friday, perhaps the idea of a softer kind of recession is in the making, but it could be extend and pretend on that narrative until the second half of next year. But Danny, the other major story we're tracking this morning on Bloomberg Brief is, of course, the geopolitical state of play. We have, before landing in Turkey, the Secretary of State, Antony Blinken, made an unscheduled stop in Baghdad, and that was to meet with the Palestinian authorities.
To anyone who might seek to take advantage of the conflict in Gaza to threaten our personnel here or anywhere else in the region, don't do it.
So that was a warning shot from the Secretary of State there, Blinken. Let's bring in our Bloomberg opinion editor, Bobby Ghosh, joining us now. It was a whirlwind tour for Blinken. The Jordanians have brought the ambassador back from Israel. The narrative from a number of the Arab states is we don't just need a pause, we need a ceasefire. So is the chasm opening up further between the Arab world and the American, and I'm very clear on this, the American response and support for Israel in their current war?
The chasm is indeed widening. It's certainly widened on the Arab street, where we've seen all these demonstrations getting more and more intense. The anger is not just directed at Israel, but to your point, also to the United States, which is seen as being an enabler. That trip by Biden to Israel a couple of weeks ago, the embrace of Bibi Netanyahu, those images are not going down well on the Arab street. In the Arab palaces, things are slightly more nuanced. I think most Arab rulers want to see Hamas defeated, but they don't want to see large Palestinian casualties happen. They need to respond, even though many of these are not elected leaders. They do need to respond to the emotion on the street. And so you're seeing things like ambassadors being withdrawn, ambassadors being called in, and Israeli ambassadors are being called in and given a talking to. It's many Arab states want to have good relations with Israel. We saw a lot of development, a lot of movement in that direction before this conflict. Now all of that is frozen. Now everyone, the first thing they say and the fifth thing they say and the 10th thing they say is reduce the number of casualties, allow, not to your point, not just a humanitarian pause, because a humanitarian pause really means a break before the next round of slaughter. Now people are talking about ceasefire. Enough, done with, now start talking.
Right. And Bobby, I mean, there's been opinion pieces written, this idea that the U.S. doesn't need to distance itself from Israel, but from Netanyahu. Is something like that even possible?
It's very difficult, Danny. Netanyahu has been prime minister of Israel for so long now. He's so closely associated with all of Israel's policies of the last 20 years that it's really difficult. I think the Biden administration has been trying to make the argument that the United States is for Israel, not for Bibi Netanyahu. Unfortunately, in the eyes of much of the world, certainly in the Arab world, Israel is Netanyahu and vice versa. It's really difficult to separate the two.
The people that I'm talking to in the Middle East have said they're reflecting on various times gone by in the 1980s, where there was an extraction of factions within Israel and they were put into exile. For any of this to progress, can we make real progress with Bibi in charge, or does the narrative need to shift where you have America saying you need to go and we need an interim prime minister that can let us find an off-ramp with this to deliver a solution post this war?
I think that the Biden administration has been quietly briefing journalists on the side, making this exact same point, that Bibi's got to go. It's difficult for them to come out in the open and say this. You don't. Of course. He's a democratically elected leader of
in the middle of a war,
close ally in the middle of the war. But the administration has been briefing journalists exactly along the lines as you say, Manus. And here they're also pointing out that Bibi is incredibly unpopular in Israel right now. All the polling coming out of Israel suggests the vast majority of Israelis want finally to see the back of Bibi. Whether they want to do it right this instant in the middle of the war is a different question. The polling hasn't sort of drilled down to that, the polls I've seen anyway. But they want to see him gone. The Biden administration wants to see him gone. He doesn't want to go. He doesn't want to go, and his right-wing allies who make up his coalition are not calling for him to go. Until that happens, that would be the inflection point. But that's not happened yet.
Right, yeah, let us not forget that before October 7th, there had been protests in the street of Israel from all sorts of people against what Netanyahu him and his government had been doing. Bobby, this also seems to make complicated the idea and the end goal of what happens after the bombardment of Gaza ends. How does it complicate things if at the same time the U.S., those within Israel, are calling for a new prime minister when, again, it doesn't seem as if there's a clear goal or outcome for what they're doing in Gaza right now?
That's part of the frustration that the Biden administration has with Netanyahu and the Israeli government right now, which is that they're not articulating a vision of what happens afterward. They're talking in fairly vague terms about what their goals are. Oh, we're going to destroy Hamas. What does that even mean? When you declare Hamas to be destroyed, it's not a conventional army where a general will come and sign an armistice or a surrender document. So when do you declare that Hamas is ended? And then what happens the day after? It's now been more than a month since the horrific terror attacks on Israel. Israel has been conducting this military operation now for several weeks. It's had more than sufficient time to articulate some kind of a strategy about what happens next. It has not done so. And this is adding to the frustration. When Blinken is traveling through the Middle East, he's being asked that at every point. What are you going to do after? When does this end? And what are you going to do after? And at the moment,
what is the credible? It's far from us to debate what the most credible solution is, but at this moment in time, he speaks to the PLO. Yeah. Abbas is a very formidable individual, or does he still have the ability? Oh. Does he have the ability really to be part of the solution for Blinken and the White House?
Well, the White House is clean.
Or is it going to be a UN, US? I mean, I've seen various things, UN, US style-led coalition trying a peacekeeping mission in Gaza. That's not really a formidable solution, though, is it?
No, I don't think the U.S. would have credibility on the ground because of the association with Israel. Abbas has been there forever, but he's deeply, deeply unpopular, and he has run the West Bank into the ground. Now, he has had constraints on what he's allowed to do, but it is a very sclerotic administration that he runs. He's not popular. He hasn't faced an election in nearly 2 decades. So the solution is not going to come from there, I don't suspect. Some sort of an interim United Nations run, led by the Arab members of the United Nations, administration / peacekeeping effort. At the moment, that would seem to be the most logical way to go. Nobody is stepping up to volunteer, not yet.
Okay.
Okay, Bobby, thank you so much for joining us on this Monday morning. Bobby Ghosh of Bloomberg Opinion. Now, coming up, Manis and I are going to talk Ryanair. It announces its first ever dividend as a unit of Ryanair CEO says that airfares will be rising over the coming years. We're going to hear from the company's CFO next on Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London with Manus Cranny in New York. Now, Manus, if I were to tell you that KKR was planning to buy Telecom Italia for over $22 billion, you'd probably think shares would be rallying this morning. They're not. Let's get into some of the Europe movers. They are down more than 2% because Vivendi says it will challenge the company's approval.
Yep, well, that's a classic KKR deal, buying the infrastructure for the longer-term cash just churning through the system. Just look at Norwegian Air, up over 1%, stock rising this morning. They've given us their October traffic numbers, earnings beat. Strong fourth quarter bookings momentum. That's different, obviously, to what Ryanair are telling us. Analysts expect the beat to trigger consensus upgrades, Danny.
Yeah, I mean, look at these Ryanair share prices, man. It's up more than 6%. Behind that, its first ever dividend. $430 million is the payout. It has growing traffic, but on the other side of things, they've warned that Boeing deliveries may slip by a few months, Manus.
Indeed. Well, let's stay with that Ryanair story. We caught up with the CFO, Neil Sorahan, on the plan for its very first dividend payout. Take a listen.
We're now comfortable that we can also sustain an annual ordinary dividend. To put this in context, the first ordinary dividend of 400 million equates to what our shareholders invested in the height of COVID. And so we're delighted this morning now to be able to effectively refund that. They put 400 million into Ryanair in September 2020. We then raised a bond on the back of that and come out of COVID with a very strong balance sheet. But going forward, the board have committed to 25% payout of prior year profit after tax starting from the next financial year. So 35 cents, which will be paid between February and September of next year. So I think it's a strong vote of confidence in the business that we have the balance sheet strength to be able to sustain large capex program, invest in growth for our shareholders, but also to return some funds to them as well.
Well, you mentioned a good chunk of that is coming from your bond issuance as well. Neil, I want to go there next, because if you actually look at your debt distribution, you have about $2.8 billion in debt coming in due by about 2027. At the same time, you have this massive payout promise. A lot of people would look at your numbers and say, well, this is great right now, but what happens when you start to see the macroeconomic risk really weigh on European consumer demand? A lot of questions about how quickly recession is going to hit in Europe, and by extension, how that's going to hit your bottom line. How are you going to service the $2.8 billion of debt you have coming due?
Yeah, well, we finished the half year with $3.6 billion in cash, and that was after paying down $1 billion in debt in August alone this year with a $750 million maturing bond, and we paid down $260 million of our revolving credit facility. We've effectively paid down half of our debt in the past 2 years. We've got a very manageable profile with the next bond maturity in 2025 and then the final bond maturing in 2026. So similar to what we've done over the past 2 years, we expect to be able to service the capex out of our own cash resources, but also the bonds as well, which puts us in a very unique position compared to our competitors who are raising funds in rising interest rate environments, paying significantly higher lease costs for their aircraft. We're actually paying down debt out of our own cash resources, which hugely widens the cost advantage that we have over everybody else. And then just touching on your demand question, demand is very strong. As you saw, we had 105 million passengers in the first half of this year. We're targeting 183.5 million on a full year basis. We've 90% of our summer 2024 schedules on sale already, and bookings are strong because capacity is very constrained in the market at this point in time, and likely to remain constrained. We're only at about 94% of pre-COVID capacity, and I think capacity will remain low for some time to come.
The Ryanair CFO Neil Sorahan there speaking to Bloomberg earlier. And Manus, we have this story, airlines struggling with high jet fuel prices, and at the same time, oil prices, they are continuing to rise.
They are. I mean, you've got Saudi Arabia and Russia. This was a news headline yesterday. They're going to stick with a curb, which is the 1 million barrels a day of unilateral cuts, Danny, coming through and continuing that until the end of the year. Let's get to Alex Longley. He is our reporter on the story. So a lot of people were anticipating this, but it was still a little bit of a belter on a Sunday afternoon. Do you think they're trying to take some of the heat out of the November meeting that we're gearing up to go to in just a couple of weeks?
Yeah, exactly. I think, as you said, this was widely anticipated, but it's a reminder to the market of what Saudi Arabia and Russia are staying the course with here, and that's backstopping any sloppiness that we might see into early next year. I think this morning you're already hearing from analysts talking about further extensions into the first quarter of 2024, and that's because people's balances just don't look as good for early next year. And this is just a sort of a refresher that Saudi Arabia and Russia are really here to stay the course and to underpin crude prices at these current levels, certainly in the 80s.
And amid this, we've seen basically all of the war premium unwind from the war between Israel and Hamas. What's driving that specific part of oil prices right now?
Well, on the one hand, we've had these OPEC Plus cuts, but you have to remember this is against a macroeconomic backdrop that's not looking great. Some of my colleagues writing at the weekend, diesel and naphtha, two of the fuels that really power the global economy, look pretty dreadful at the moment. And particularly in Europe, that's because industrial demand is so bad. So that's what the market's been focusing on after we've not seen any disruption in the Middle East from the conflict. And that's why we've had this pullback and then support today from the OPEC Plus cuts.
Do you think we just get back to basics? Sorry, Alex.
Sorry, go ahead, Manus.
Do you think we just get back to basics and we look at China and we look at the demand? I mean, if you look at the Saudis' pricing to Asia, it remains firm. But is it sort of fill or kill on breaking $100 and what happens with China?
Clearly, China is going to be the biggest driver. You talk to anyone from oil traders to tanker owners, that's the core of demand. Yeah. But I think if you talk to traders at the moment as well, they worry a lot about what's going on outside of China. China can hold up on its own. But if the rest of the world is slowing, that makes a $100 narrative pretty hard to fulfill for the time being. Inventories, however, are very low, and that's what's keeping the bulls excited at the moment.
All right, Alex, thank you very much. That is Bloomberg's Alex Longley. Manus?
Danny.
I feel like I keep interrupting you today.
Well.
I don't know what's going on.
No, do you know what it is? Just
so
over enthusiasm for a Monday morning. You know, you've not done your spreadsheet. I just want everybody to know that she's not done her spreadsheets.
I didn't.
Yeah, and she didn't find enough of a hard fact of the day to call me and impress me at like 3:30 and go, I found the fact of the day for you. Have you?
Yeah.
No.
It's true. The spreadsheets, for some reason, ground me in the morning and stop me from talking all over you. So I'll get back on it tomorrow. All right, Manus, we are going to take a look at some of the market-moving events to watch throughout the week. A lot coming up and a lot of Fed speak. Welcome back to Bloomberg Brief with Danny Berger in London, Manus Cranny in New York. Let's get you set up for the week and a look at what's ahead. On the earnings front, there's a lot. UBS, Uber, eBay, and Occidental all report on Tuesday. Disney, Ralph Lauren, MGM Resorts, they have their results on Wednesday. We're also going to hear from major central banks with Governor Bailey, Chair Powell on Wednesday, and then President Lagarde on Thursday. There's also some key eco data on deck. We're going to get inflation data out of Germany and China on Wednesday. U.S. jobless claims on Thursday, plus UK JDP, UMich sentiment on Friday. Manus, I hope you got your sleep over the weekend. That's a lot.
Yeah. Can you pack any more into that sort of the week ahead?
Don't think so.
Don't think so. So I don't know whether you have a car still in the zone that you live in London. I had one for many years.
I don't even have a driver's license. I don't have a UK driver's license. So I definitely don't.
That's actually a curveball of all curveballs on a Monday morning. So, you just sort of hand Danny a nice line about, oh, no, Manus, I don't have a car. I live in zone whatever. And you go, no, I don't even have a driver's license. Which reminds me, I need to get my American driver's license. But Tesla, here you go. So the least expensive car that they have so far is about 42,990 euros. Looks like they are going to produce a 25,000 euro electric vehicle in Berlin. Now, this is according to Reuters. So that is going to be a real game changer. I mean, the Model 3, the least expensive one is 42,990. 25,000 euros, you'd have one of those, wouldn't you?
Yeah, not too bad. Hey, look, if you don't get one of them, you can get an Uber.
I actually deeply want a smart car.
I
I want a smart car, actually, for New York. I don't think
What
there's
is a smart car?
It's the little car.
Oh, like the little smart car.
Yeah. Yeah.
That would be really good for getting around New York, actually. I think that's way better. I mean, you can't have like a luxury car in New York City. That thing will get ruined.
Understated.
There's no way.
I've come to the conclusion, life here, I mean, I don't need to do understated. I just haven't got as much as everybody else. I think that's the general conclusion. Can I afford an Uber? That's the question.
Yeah. I love that. Understated, not by
Elegance.
choice. Yes, Manus. Uber, they're going to have earnings on Tuesday. But here's this one headline now. Uber and Lyft to pay $328 million in back pay to New York drivers. So if you take an Uber, Manus, the drivers, they'll be getting paid more.
They'll be happier. They'll be smiling. A bit like you and I at 5 a.m. every day on Bloomberg Brief. Surveillance is up next. They smile a lot on that show. Good morning from New York.